What is going on, traders? So if this happens, the market could actually hit near bear market status, or bear market status in my opinion. There are a couple of different levels that I'm looking at across a few different charts. We will get into that, and trust me, you will want to see this because it will pertain to your portfolio. And I will also show you how I'm hedging my positions as well, so that you can get an idea and know that it's not just all doom and gloom. There are measures that you could take against these turbulent times. Let's get right into it. If this is your first time on the channel, welcome to the Traveling Trader. If you get anything out of this, leave it a big fat thumbs up. Let's get right into it. So looking at the charts, there are a couple of charts that I'm looking at from an asset standpoint. I'm looking at TQQQ, which is the ETF, the leverage ETF that tracks the NASDAQ. And then obviously I'm looking at the SPY. Both of these things are at major support here. The TQQQ hasn't been at the 200-day moving average or below it since the COVID crash of 2020. And the SPY is currently sitting at the 100-day moving average. Both of these, by the way, if you're a long-term investor, these are levels that you want to start dollar cost averaging in my opinion. But we'll talk about that when we start getting into trades and investments towards the end of the video. And by the way, everything will be delineated by chapters below, so feel free to go forward and backward as you like. So I'm looking at these two levels here. Now, will they breach? There isn't really any way of saying whether they will breach or not. I mean, we could take a look at things such as options flow and see whether they are bearish or bullish. On the TQQQs, we are now seeing more calls coming in than puts, a lot more calls coming in than puts, over twice as much as a matter of fact. And that's because of the fact that it is sitting at a major moving average here. And the TQQQs is down from highs. If we measure it from the highs, you know, we are down. We are in a bear market in the TQQQs, not in the NASDAQ itself. But remember, this is a leveraged ETF. On the NASDAQ itself, we are near correction territory, not quite there. Remember, a correction is 10% or greater of a drop, but below 20%. So we're almost at minus 8%. Now, if we got to this 200-day moving average on the NASDAQ, then we would be very close to correction territory. And if we take a look at the option flows on the SPY today, you could see that they are still bearish, very bearish. So that means that the market is looking at the SPY and saying, hey, the SPY actually could fall from here, could fall below the 100-day moving average. That is at least what the options market is anticipating. However, remember, these also could be hedges, meaning that just like us, how we hedge our portfolio, and I had a pretty large SPY hedge last week that I closed out. But you know, these could all be hedges, meaning a lot of people hold the S&P as a benchmark in their portfolio, or S&P based stocks trying to mimic the S&P 500. And so they could be buying puts just as insurance. It doesn't mean that these are main positions or that these are bearish bets. It just could mean that institutions and investors alike are hedging using the SPY. Now, here is what I'm looking at. So if you take a look at the 10-year treasury yield. So the 10-year is considered the benchmark in terms of treasury yields, right? You have short-term treasury yields and you have longer-term treasury yields. So the 10-year is somewhat in the middle, and it's considered a litmus test for what is to come in the markets as well as the economy. The 10-year treasury yield busted through this 1.8% resistance, and we're currently trading at around 1.85%. Now, here's what I'm looking at intently. I'm looking at the 2% level. Why is that? Well, first of all, 2% is a round number, and you have that round number bias, right? So if we take a look back in 2015, really the first time that the Fed said that they were going to start raising rates after the 2008 financial crisis, once we crossed that 2% threshold and we got to, this was around August, September of 2015, we crossed that 2% threshold. We even almost hit 2.5. That's when the market saw its first correction that year. The 10-year yield dipped back below 2%. And then once it climbed back up again above 2%, we saw another correction. This was around February of 2016. So it was like a double dip correction, almost a bear market. And then rates started tanking again as people flooded into bonds, taking their money out of stocks, looking for safety. See, the relationship between bonds and yields are when people are selling off bonds because they know that rate hikes are around the corner, meaning they will likely get a better deal, which is why they're selling it off, or they're afraid of inflation, right? Because if a bond is offering you, say, a 1.8% yield and you think that inflation is going to be really high at 7%, then keeping your money long-term in bonds is going to get eaten up by inflation. That 1.8% that you are getting in bond yield is not enough to fight the inflation rate. So those two scenarios are the reasons that people start selling off bonds, either because they're afraid that inflation will overtake the rate that they're going to get paid for the bond, and or rate hikes are right around the corner and they know that bonds will be paying more. So they let go of their bonds today and wait for those rate hikes and then jump back into bonds. But stocks don't do well when bond yields are rising for a few reasons. One, because bonds and stocks are competing asset classes, right? So if bond yields are now offering a more attractive investment, then people will be taking their money out of stocks, so removing liquidity from stocks and pouring them into bonds. Also, higher yields mean that the cost of borrowing money is more expensive. So growth stocks that rely on leverage in order to grow now will cost them a lot more to borrow that money and to grow, meaning that it will eat into their margins and their profitability, etc. So we will be watching these yields like a hawk, more specifically the 10-year yield. You want to watch this like a hawk and see if we get above that 2% yield, because my bet is if we get above 2%, then you will likely see a near bear market in stocks. And those levels that we talked about in the SPY and in the NASDAQ, we will likely get below this into near bear market territory. Now, I don't think we'll get to a bear market, meaning 20% or more, because back-to-back bear markets are very uncommon historically. And also, this would be the first time in 43 years that the bond market posted 2 consecutive years of losses. And you might be thinking to yourself, what do you mean losses? I thought the 10-year yield was rising. Yes. So there's an inverse relationship between bond yields and bond prices, meaning when yields go up, bond prices go down. When yields go down, bond prices go up. So when we say that the bond market is going to experience losses, we're not talking about the yield, we're talking about bond prices. So if you look at something like, if you look at the 10-year, not the 10-year yield, but the 10-year bond price, you'll see that it is actually tanking because there's an inverse relationship between bonds and yields. And if we close for a loss this year, that would mean 2 years of consecutive losses in bonds, which hasn't happened in 43 years. 2021, we had a negative 0.86% in the 10-year government bond. And 2022 is not off to a great start. We're down 3%, but it's not surprising because this is the year that the Fed is going to aggressively raise rates. They talked about 4 rate hikes. I don't think that's the case. I think that the Fed, they don't only look at the stock market, they also look at the bond market. And they noticed that between 2015 and 2018, we had slowly rising interest rates. They did it very slow over a period of 3 years, whereas now they want to rip the Band-Aid off and do 4 rate hikes in 2022. I don't think that will be the case. We talked about in previous videos how the Fed can easily switch policy. Everything will depend on January 25th and 26th when the Fed actually has their FOMC meeting and they are going to dictate official policy. And I thought it was hilarious seeing this headline here. President Xi Jinping warns the Fed against hiking interest rates. Obviously, the US is China's biggest trading partner and vice versa. So he's saying that don't raise rates too fast. It's just hilarious that the president of China is sending a message to Jerome Powell. But, as a matter of fact, he might have to listen to him, maybe not taking Xi Jinping's advice necessarily, but Jerome Powell might be looking at the bond market and the stock market and seeing the potential quick bust of those markets and rethink this 4 rate hike thing during 2022. So in summary, I would pay attention to the 10-year yield, see if it gets to that 2% mark, because if it does, I guarantee you we are going down further. Also, take a look at the 20-year yield and yields all across the board, although the 10-year is considered the benchmark. But the 20 is also pushing up higher. We're above 2.23%. And, if we get to that 2.5% mark on the 20-year, similar fate, right? So we need enough people to pour into bonds for these yields to go down so that the stock market can appear more attractive than the bond market. Remember, the bond market is much, much larger than the stock market. A lot of people don't realize that. All right. So in terms of trades, what am I doing? Well, just like you see here on the options flow, you could buy puts as insurance against your S&P based stocks. You could just buy flat out puts that expire a month out. Another thing I like to do is vertical spreads against the indexes. Last week, for instance, we sold the 468, 469 call spread on the SPY, meaning that we needed it to be below 468. Currently, it's trading at 457. I closed that position for 40%. In hindsight, could have closed it for a lot more profit, but can't win them all. And it is a hedge. You keep it open for as long as you are comfortable. Day trading is a great way to get around the volatility as well because it's very neutral. You could see our day trade watch list here. This is another way that we hedge. It's not really a hedge. We do this every single day, but basically we have calls ready if a stock breaks a certain resistance level or puts ready if it breaks below a certain support level. And we are neutral. I don't care whether the SPY or the QQQ or Tesla or Apple, I don't care if they're bearish or bullish. I'm just looking at the levels that I identified beforehand. I draw them pre-market like this. And if we cross above, then I buy the calls that I indicate. If we fall below the support level, then I buy the puts that we indicate. So we send this out every morning as well. If you want access to all of our trades, come be a part of the community. You learn how to hedge, day trade, etc. It's a great value. There's over 4,000 traders in here talking trades all day, every day. One other thing you could do is buy volatility calls. So buying calls on UVIXY or the VIX. VIX currently has breached the 20 level for the first time in a while. It's probably going to close above the 20 level today as of the time of this recording. I have $25 calls on the VIX expiring in February. I opened those a couple of weeks ago. I'm down on those still because they are out of the money. But if the market continues to drop and the VIX crosses above that 25 level, then I have earned some insurance money for my position. I also have covered calls against my Tesla shares and against my Apple shares. This is where if you have 100 shares of stock at least, you could sell a call above resistance. And if the stock never breaches that, then you keep all of the money. So for instance, I sold a 190 call in Apple expiring February 18th. And if Apple's not above 190 on expiration, then I get to keep all the money I sold the call for. If it's above 190, then I'll get to sell my shares of Apple at 190. And I still keep the money that I sold the call for. So in my opinion, it is a win-win. So there are really an endless number of ways to play this. Come be a part of the community if you want a chance to engage in some of these trades or some of these discussions, and you might learn something. There are traders of a variety of experience levels. There's really experienced traders, there's beginners, etc. So, we try to get everybody up to speed, and it's a great community. If you got any data or information out of this video, hit that thumbs up. Leave it in the comment section below. Let me know what you think the market is going to do. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.